Good afternoon. My name is Mark Karamat. I'm a project marketing specialist for California Coast Credit Union, and welcome. Just some housekeeping rules. We they're cleaning it right now, but the men's bathroom is across the hall, and we're in a secure building. So if any of the ladies need to use the restroom, let one of us know, and we can walk you around to the other side. Um, Also, at the end of the presentation, we'll be raffling off a $25 Best Buy gift card for those who fill out the evaluation form. It's good for us to have those because it helps us provide you guys with the right topics and try and improve every time we do these workshops for you guys. And so I'd like to also introduce our speaker today. His name is Oliver O'Brien. He joined John Hancock as a member of the National Sales Support Team in 2014. Recognizing his contributions, he was quickly transitioned to the position of internal sales support for the regional vice president in Southern California. His combination of experience with product design and positioning, as well as his in-depth knowledge of sales and distribution, have uniquely positioned him for success as the regional vice president of Southern California. Prior to joining John Hancock, Oliver was a licensed banker with Citizen Bank and a life insurance agent for the New York Life Insurance Company. He holds his FINRA Series 6 and 63, along with his life and health and variable annuity licenses. Currently, he resides in Carlsbad, California. So please welcome Oliver O'Brien. Thank you.
Thanks. Oh yeah. Nothing like those corporate long-winded bios that no one really understands. But essentially, I started in the mailroom and just kept working. So I mean, I love Hancock. I'm third generation John Hancock. My whole family's worked in insurance, life insurance, and obviously, I'm here to talk to you about long-term care and the benefits and the oversight and how people often overlook how it compounds and affects all the hard work they've done with retirement planning, estate planning, etc. So just I kind of want to start with a 30,000-foot view where the marketplace is right now with long-term care. So for a long time, we had pretty much just what dominated the industry was standalone, what we call standalone long-term care policy, right? So it was just a policy took out similar to a life insurance policy. Life insurance has a death benefit attached to it, and long-term care had a benefit pool, and you could select the amount of time you predicted you'd be on benefit, and you could add an inflation factor, so on and so forth. And essentially, what happened is, don't tell Hancock, but the actuary screwed up, and it became incredibly expensive. So right now you're seeing everyone pulling out of the marketplace and not offering standalone long-term care. And if any of you have a policy from over 5 years ago, you're essentially in the money and stealing from the life insurance carriers. So good for you. I can tell you that right now. So what's happened is, with the drying up of that space, carriers are going to specific departments of insurance in different states and hiking up rates. So what you were paying, say you were paying $1,000 a year, they're trying to up it to $1,500, $2,000, so on and so forth to get their money back, because the lapse rate nowadays on those policies is less than 2%. So that's what we're seeing out there. And my presentation today is about a new innovation that's been around for, I don't know, maybe about the last 10 years. And it's called a long-term care rider. And it's a rider is an add-on to the policy. So when you purchase life insurance with us, you can add a long-term care rider to that policy. And what it'll do is it'll be essentially killing two birds with one stone. So you'll have a death benefit like any traditional life insurance policy, but that death benefit pool can be utilized if you go on claim for long-term care for a long-term care benefit pool to be used until you exhaust the death benefit or you use part of it. And then of course, when you pass, the death benefit left over is going to go to your beneficiaries and heirs. The other product that's out there is a hybrid product offered by Lincoln. It's called MoneyGuard. That's a mixture of both a standalone policy and life insurance. And I'm just trying to give you. Obviously, I'm here to try and promote John Hancock, but just trying to be objective and give everyone here a good snapshot of what offerings are out there. So the other carrier is Asset Care, and it's the same thing. It's essentially a whole life policy mixed in and hybridized with standalone long-term care policy. So that's the boring part. Hopefully you're not falling asleep right now. I'm really happy that none of you have eaten the sandwiches. That's the worst when you're doing a lunch meeting and everyone starts kind of glazing over when the food hits their stomach. But I kind of want to move along into what we're seeing out there to drive home the point of why we need this in our planning and why it's so often overlooked. Me and my family, my grandfather is the case of what not to do. He never purchased a plan. He was a stockbroker and estate planner, so he should have known better, right? And he let his life insurance lapse, and we had to draw down on the house that was paid for, his retirement, right, that he was trying to leave to my grandmother and his kids, and he wasn't able to really accomplish his end game goals. My grandmother, who lived for another 18 years, got wise and saw what happened and purchased a long-term care policy. And she was able to basically have 24-hour nursing care in her own home. She was very obstinate. I mean, good for her, right? She didn't want to leave her home. She wanted to go to a nursing home, and she was able to stay at home until she passed. So that was I believe about 3 years of round-the-clock care that was paid for, taken care of by the insurance carrier. And the value I can't stress enough, because you didn't have to take a second mortgage, a home equity line of credit, draw down on Social Security, whatever you have out there as an asset mix for retirement. You need to protect that, and that's why long-term care is vital. Honestly, I can't tell you how many people say they're going to self-insure, right? Or my kids will take care of them. And I'm going to go through this to kind of show you what happens when reality hits, rubber hits the road. And right now, if you don't have a plan, I already kind of went through this. The biggest thing is you're going to be paying out of your retirement portfolio. You're going to draw down your retirement right away. Now, who here thinks that taxes are going to go down? Does anyone think taxes are going to go down? Yeah. Does anyone think that, I don't know, the cost of care, nursing homes, is that going to go down anytime soon? No. You think your retirement plan is going to keep up with all of that when need be? Probably not. I mean, especially when you consider that you're going to be paying taxes, right? With RMDs, you're going to be paying taxes on your gain. Even Social Security past a certain threshold, you're going to be looking at, taxes. And what does everyone tell me? Well, that's good, but I'm all set, Oliver. I'll simply just use any other asset that I have out there, and I'll use Medicare and Medicaid, right? Well, does anyone know about the limitations associated with Medicare? I mean, there's quite a bit. And Medicaid, is everyone familiar with what Medicaid actually is? If you're going to go into a Medicaid nursing home like they have in Boston, I mean, trust me, they're very 5-star, they're plush. You're going to get all the care you've ever wanted as a thank you from the state. And these are just the realities I have to drive home, having seen it with a lot of my clients that I've worked with over time that didn't institute it. So, your income and assets are going to pay for long-term care, but have you considered essentially the extra monthly income that's available, right, to cover this? What's discretionary in your expenses account, and what assets do you want to liquidate first, right? Thinking about the drawdown. Now, what are the tax consequences? And like I was saying earlier about inflation and getting a good return on your investments, if you do decide to self-insure, what's it going to look like in a down market? People forget the sequence of segments and returns, right? You could be investing at this point in time and not get the same return as if you just waited a little down the line. Excuse me. Oh, getting a little dry. Bear with me here. So, having covered the basics to hopefully freak you out a little bit to get thinking about purchasing long-term care, I want to kind of get into the support for daily expenses and how we're going to pay. And the biggest thing right here I want to pause on is your children or a loved one, they're going to step up and pay for this, or they're going to provide the care. I was just at a conference on insurance, and there was very, very interesting research to, basically get at the matter that anytime you're planning on your children or any your spouse or any family member to come provide care, it's not all puppy dogs and rainbows. Right now, the analysis they have is 72% of all relatives that are providing care at home to their loved ones suffer from some form of anxiety or depression, and it's because they're basically watching, someone very close to them, their loved one, in the worst time in their entire life. I mean, I don't need to continue on that. And then you got to think of the drawdown, right? Say, you have a daughter. Oh, she's going to take care of me. Well, what if she has a successful career as an attorney, or maybe she's working as a nurse, or maybe she's taking care of 3 kids. So we have to get to the granular aspects of the plan, and not take anything for granted when we're looking at this. Every plan is essentially individualized. So this is what I was referring to earlier. When you're combining life insurance and long-term care coverage, you're going to be covered across the board. So this is, very hybridized and cost effective, right? And if you do have existing life insurance, I get this a lot, you can always purchase a life insurance policy that fits the need strictly for long-term care needs, and kind of skirt around the expensive nature of the standalone policies that are out there. I see that a lot. And when we're looking at planning, we don't need to use the entire death benefit to have for a long-term care plan. There's a lot of ins and outs and technicalities with these kind of plans. So obviously you consult, your reps here, and I have Brianna's in the back who's fantastic. Now, what happens is, say you take out $1 million policy, $1 million life insurance policy, death benefit, and you don't want to have that totally exposed when you go on claim for long-term care. What you can do is you can allocate a certain percentage of the death benefit, say half of it, 500,000, just to go for death benefit for your loved ones, and then long-term care. So there's a lot of flexibility in this type of planning that you wouldn't normally see in the expensive standalone market right now. Now, that being said, I can't stress enough the fact that when you add a rider to a policy, so if you're paying, say, $2,000 a year for your premium on a life insurance policy, and you add the long-term care rider, it's just a 7% increase. So it's incredibly cost effective. Not to mention, in life insurance policies, you're going to have cash value buildup, right? So you have the flexibility when your needs change. Say you don't need the policy. Say you want to take a loan out against the cash value. You have a lot of options, is what I'm trying to stress. Now, this is the classic case study that we see at John Hancock. 52% of our policies are sold with a long-term care rider on it, and the average age is 55. It's essentially between 45 and 65 that we see every case come through with long-term care, to the point now where people in the industry, or agents and advisors I work with, they literally lead with a long-term care rider on a sale, because that's the importance out there right now for coverage. And I'll tell you a little anecdote right now. I work a lot with financial advisors, and I have a financial firm in Scripps Ranch, and I went in there and I talked about protecting their clients, right? Protecting their clients. And I used to call it build a wall. Then Trump got elected, and I couldn't use that anymore in my company. So I call it build a moat around my retirement. And I basically highlighted the drawdown effect if they don't do the value add with their clients and protect the risk portion of their portfolio. So play that out, right? So if you don't have long-term care or just essentially long-term care with a life insurance policy, client goes on claim. So a claim happens when you can't perform 2 out of 6 activities of daily living. So it's taking care of yourself, showering, bathing. I don't need to continue on to all the other morbid things. And then you have a plan of care from your physician, and he submits it to the life insurance company. The company has a usually 30 to 90 day what they call elimination period or waiting period, which a lot of times, the gap in your Medicare policies will cover for the most part. Now, when you go on claim, the way our model works with Hancock is you are not capped by the IRS. And I'll cover that in a little bit. So the value with us is you can accelerate for long-term care up to $50,000 a month for coverage. So think about that right now. I mean, what's the cost of care of a nursing home in La Jolla? I mean, it's about $15,000, $16,000, and it's going to continue to rise up, like my point on inflation earlier. So you're covered over the inflation objection. The rates on the policy are guaranteed, so we can't go to the state and try to hike up your rates, which is very, very important. And we do it on a reimbursement model, so it's tax qualified. And what that means is if you're in a La Jolla nursing home and you incur that month $5,800 of receipts of care, but you have access to $50,000 at any given month, and then the next month you incur $40,000. You're preserving the death benefit, which is your pool of long-term care benefit, in an adequate way. Now, I'm going to talk about HIPAA per diem and the technicality of all of this, and get back to the financial advising firm in Scripps Ranch. So they were gung-ho about risk aversion. They implemented, care for all their clients, and they had 2 long-term care claims on our policies within the first year of selling them on older one. And they ended up passing away about a year later. So they were on claim. They had the value. They were protected on their investments, and their beneficiaries, their kids, got the death benefit. So it was a self-fulfilling prophecy because the kids who had the death benefit tax-free saw the value that the advisor did, right? And they came back to him with that death benefit. So these are a tale of 2 cities. So I have another one in Irvine. They didn't do that. And they lost about $10 million in assets under management. And now their kids are like, forget this guy, right? So, I mean, it's on both sides is what I'm trying to say of the industry. When working with an advisor, a lot of them are hesitant to bring this up or hesitant to look at life insurance in the first place. Now, if you stress to them that you need the protection, you need the risk aversion in your portfolio, because it is part of it, then you can definitely push it through. I can't stress that enough, because I've done it myself with my mom, and her Charles Schwab advisor's like, we don't need to do long-term care or anything like that. And then I got on the phone with him and quickly pointed out how he's going to end up, not only doing my mom a disfavor or any one of his clients a disfavor, but he's going to end up losing clients going forward. Now, just kind of moving into the technical aspect of the long-term care pool. So, I mean, I've covered most of this with the benefit pool and the tax-free death benefit. I kind of want to just move along into the technicalities of how these work when you institute a claim. Now, I already mentioned 2 out of 6 activities of daily living. You're obviously, the other piece is, severe cognitive impairment. Like my grandfather was Alzheimer's, and it was tough because he had to go to a nursing home for care for a year. And like I said, that was really unfortunate financially, but also emotionally. I already mentioned the elimination period, and then the biggest thing is the flexibility of a choice of setting when you go on care. So with us, you have a nursing home. You can have home health care. There's even assisted living facilities. There's adult daycare that's also available. You can mix and match what's going on for your plan of care, where a lot of other carriers have restrictions on what you can do with that. And We have, God, 37 years in the long-term care business, dealing with legit every kind of home health care provider, nursing home, assisted living facility that's out there. And that's a powerful message. We offer a concierge system, so when you're not alone, you're not having your family members call in, manage all the receipts, basically run their own business. And one of the biggest things I can't stress enough is the claims procedure. Having almost 40 years and dealing with claims and not having really any issues is a powerful thing. And we're the ones, like, once you set up your plan of care with, say, a nursing home, we kind of take the ball and run with it after that. We're the ones that are going to deal with them. We're gonna get the receipts. We're going to reimburse. We essentially take the stress off you, so you can just focus on taking care of your family and being with them. Before I end here and go into questions, now I need to point out that there's two types of long-term care riders in the industry right now. There's ours, which is a true long-term care rider. What I mean by that is it's tax qualified, and there's no limitations on what you can utilize on a monthly basis, like referring back to $50,000, which is quite a bit of money. The other thing is called an indemnity rider, and indemnity rider is going to be limited by what's called the IRS per diem limits. So, do you think the IRS keeps up with inflation, rising healthcare costs? Obviously the answer is no. So we've seen last year the indemnity IRS per diem limits were $10,800 a month. This year they moved up to $11,200 a month. Now, what that means is you have essentially non-taxable acceleration of your death benefit coming to you that's limited by the IRS at those caps, right? So you're hogtied to that. Anything you accelerate above that for your needs, you could be looking at a taxable situation, depending upon how you utilize it. The other component of that is a check is just being spit out to your family member. I have a couple of shady family members out there, so I don't know if I really want them managing that. I don't know if they're equipped to do so. And we've seen an incredible amount of fraud on the indemnity side, because of that, because it's just a check coming out every month. Now, a lot of people also think that because I'm getting a check, say I'm getting a check every month for $11,200, and I'm just going to be the home health care aide, right? Well, that's also, you can run into an issue, because you have to be certified to do a lot of these things in order to use the money in a proper fashion. So you have a multitude of things that are putting a lot of strain on people that many people just don't understand. And the biggest part is the IRS is not going to keep up with inflation. They're already not doing that right now. So, contrasting tax qualified reimbursement, like I just described with John Hancock, versus an indemnity model, where the IRS is really capping you and they're really paying attention. And if you aren't a certified home health care giver, you could run into particular regulation issues. If you need more money for that nursing home in La Jolla at 15 grand, well, you're over the cap. Now you're going to be in a taxable situation and receive a 1099 for that difference. So these are a lot of things to consider when you're doing planning, whether it's with us at John Hancock or any other firm. These are the little bit of tidbits people often overlook, and I just can't drill that home enough, because I've seen a lot of people misconstrue that, and then they get a 1099 and they're like, wait a second, I was paying for that nursing home for 15 grand. Why am I being taxed at my income rate? And that's a big oversight, a big overlook. I guess just open up the questions. Hopefully, you got something out of this. It's a little, we're talking about morbidity. It's always a good time, right? Life insurance is a very fun topic to talk about. But does anyone have anything that they'd like to ask? Any questions?
I see that there's 100-day waiting period. Do you have to have invested a certain amount in the life insurance before it kicks in?
No, it's strictly contingent on long-term care. So once you satisfy, go and claim the 2 out of 6 activities of daily living, the elimination period begins. Now, another good point, I'm glad you brought this up, is sometimes it's calendar days, right? So say it's 100 days, you start today, 100 days from now, you are accessing your policy for long-term care needs. The other thing is called service days. What service days means is, you have to have service for, care, like your long-term care. Now, that's where you can get a little bit in the weeds from carrier to carrier. I know Hancock, we're service days, but the great part about that is, if you get 2 hours of service, it actually counts for 7 days, because we know that a lot of people aren't able to afford the amount of money to have someone come to their house for 100 days straight. That's just how it works. California is very, very lenient and very sympathetic to people getting on claim right away, regardless of elimination periods. That's just how it is out here, and also Florida. I mean, shocker there. Does that make sense in terms of? Okay, great. Yep. Yeah. So when we're underwriting, we're not underwriting a long-term care on. Oh, yeah. So the question's on underwriting, which is, how do we underwrite? What qualifications physically can get you underwritten and actually issue a policy? So life insurance is done on a mortality scale, right? So how long are you going to live? How healthy are you right now, and how long are you going to live? And morbidity is how long-term care is done. Essentially, how quickly are you going to get sick? How quickly are you going to have all these ailments? So when we underwrite separately. We underwrite on those two tables. Now, if you have frailty, cognitive impairment, hip replacement, knee replacement, anything that's at a very high risk to have a repeated, anything that's going to put you at a risk to go on claim right away. And I had an NFL player a couple of years back. He was 30. He had a spinal contusion. He couldn't do anything. So he actually had one of our policy long-term care rider, and he went on claim for, I think, about a year. And then he got better, went back to play for another 2 years. And, you can go on and off claim is my point. Now, if he went to apply again for long-term care, he'd be a no-no. Absolutely not going to happen. Does that kind of fill you in? Cool.
I have a question from our online webinar. It's a two-parter. My mother just turned 60. How much per month would I be paying if I bought life insurance with a rider, long-term care rider? What's the difference if I buy a policy now versus in 10 years when I am doing better financially?
So, kind of two-parter there. So he's looking to purchase it on his mother at 60 years old, but 10 years from now?
Yeah, I think that's the way I read it. Yes.
It would be more expensive. If like getting back to mortality, closer you are to death, just putting it out there, the more expensive it's going to get. The older you are, you're going to have to pay more. Now, on the other piece with, my mom's 60, she wants to purchase a policy with long-term care. That's where we need to pivot to Brianna and her expertise with, talking to that person and figuring out how much do you want to have for a life insurance death benefit? How much do you want to have accelerated every month? What's your health, right? Start right there. How much do you want to pay? I mean, there's a lot of variables on that. I get asked that all the time by my friends. They say, "Oh, I got 3 kids. I've always been meaning to buy life insurance off you, Oliver. I'm 34 now. How much does $1 million cost me?" And I'm like, I don't know, anywhere between $50 to $500,000 a year. You tell me. So.
you don't know if you're insurable or not. So is the rider based on, are you purchasing a limit, like $80,000 limit, or how does it work? Because I have a friend who currently has long-term health care that's $80,000.
No, it doesn't. It doesn't work like that at all. The long-term care limit is done on a monthly basis, and it's $50,000. That's where you cap. Yeah, and then as far as the death benefit amount, that's where you get a plan to back into what you're going to need. Death benefit, we essentially go all the way up to $20 million for long-term care coverage, and you can only accelerate so much. So you're always going to have excess when you start getting into huge death benefit amounts. If that answers the question, there's a cap, 50 grand, and I mean, sky's the limit for how much you want to apply for death benefit.
I'm sorry, you said 50 grand a year?
Per month.
Per month.
Yeah.
I hear whole life, but I don't hear you say anything about term.
Well, it's not allowed on term insurance. Given the nature of term just being pure insurance, and that's because there's no cash value there. So that's no one in the industry is offering a long-term care rider on term insurance.
The average cost to services for burial is about $50,000. That includes the services, the casket. What long-term pay for that?
It wouldn't cover that. Yeah, but then you have to back up and think about that's what the death benefit that's attached to it would cover. Yeah.
Do you mind restating the question just for the webinar? I apologize.
Yeah, I mean, he was inquiring about burial insurance, final expense insurance, and would long-term care cover that? It wouldn't. I mean, it wouldn't. What you do is you'd use the death benefit to cover that. What's left?
Thank you.
How do you determine, as far as the premium, how much is allocated to the death benefit and how much is allocated to the long-term care?
It's pretty straightforward. So, say it's $1 million policy, and before we add the long-term care rider or the premium, I don't know, let's say, sake of example, is $5,000. Now, there's no separate premium for this and premium for that. It's just an add-on, and the average add-on price of that's about 7%. So it's incredibly, inexpensive. That's right.
I have another question from the webinar. What do we need to do if we're interested in getting a quote? Do you have to have life insurance with long-term care? I have no children, so I do not need life insurance.
Yes. Yeah. I mean, you would have to have life insurance. Now, that's a great point, because I'm seeing a big trend in the industry where people are literally just purchasing life insurance policies for the long-term care rider, and they're using the policy just as a long-term care policy. So you can do that. I mean, if you don't need life insurance, just purchase the policy and use it with the long-term care rider. And the other point is it's much less expensive than going the alternative.
Thank you.
Oh, and the other point, if they need a quote, just let you guys know, and Brianna would be the one to help you out with that.
If you have the rider, and then you also have other forms of insurance that are paying for the long-term care, such as somebody who qualifies for Medicare or Medicaid, then how do those work together, and who does that coordination?
So sticking with my company, we would coordinate the care when you're accelerating for the long-term care rider. We take your receipts, we work with the nursing home or whatever facility, home health caregiver you're working with. But as far as having layered coverage, that's what we call it. I mean, you can do that. I mean, you could have a lot of coverage if you. I mean, I know people that have multiple standalone policies for long-term care, and they have a life insurance policy with long-term care rider. And biggest thing that I see is, I mean, it's predominantly on females. That's the biggest demographic that's purchasing these policies, because I'm probably going to die of a heart attack immediately, and my wife, if she goes on claim, would be more apt to go from anywhere up to 6 years. Think about Suze Orman. Everyone knows Suze Orman, and she always totally hated long-term care, by term, invested difference, and all that kind of stuff. And her mother went on claim, and they didn't have long-term care. So her mother's been in her house for over 6 years in her penthouse in Manhattan, and the incurred cost every month is $26,000 a month to have a nurse provider in there. And so she's totally changed her tune as far as long-term care goes. So it's good to see.
All right. I think that will conclude for today then.
All right.
Thank you very much.
Great. Thank you.